I am delighted to welcome you to today's OTC Live event. First, we are proud to announce that our 2019 OTC conference here in Houston was chosen as one of the top 100 trade shows within the United States. It was named as a member of the class of 2020 for Trade Show Executives Gold 100. Congratulations go out to all those involved in creating this event, as well as our thanks to all of our sponsors, speakers, exhibitors, and participants. And now I am delighted to introduce our panelists from Rice University's Baker Institute. As many of you are probably aware, the Center for Energy Studies within the Baker Institute is the top global energy and resource policy think tank and has maintained this standing by ranking #1 for the last 3 executive years. Joining us to discuss what's next for world oil and gas markets and related offshore development from the Center of Energy Studies are Mark Finley, Fellow in Energy and Global Oil, Jim Crane, Wallace S. Wilson Fellow for Energy Studies, and serving as our moderator today and taking over from here is Ken Medlock, the James A. Baker III and Susan G. Baker Fellow in Energy and Resource Economics and the Senior Director within the Center for Energy Studies. Ken?
Thanks, Carrie. It's a pleasure to be here, and thanks for the invitation to actually participate in this webinar. For those of you who've been following us, you know that Mark, Jim, and I have pretty much once a quarter since last April convened to really talk about what's going on in oil markets. And suffice to say, it has been a roller coaster. There have been a number of unexpected events, and we start with the pandemic, of course. But you layer into that the brief spat about production quotas between various OPEC plus members, in particular Saudi Arabia and Russia, the pain that wrought on global oil markets for a brief time in the midst of a dramatic decline in demand. And then the slow sort of gradual climb sort of out of the doldrums that we experienced in April and May. So it's been remarkable. The future is anything but certain, hence the title of today's webinar. It's a great topic for conversation. And in fact, the topic would apply no matter when we are historically, because the world of oil and gas has always been uncertain. It is an incredibly connected world when we think about producers, consumers, operators in the production and midstream. They're all codependent in many ways. And thinking about how factors might impact any one part of that complete value chain is really at the core of some of the stuff we're going to get at today. So with that, I want to invite Mark and Jim to the floor. We're going to start with some comments from Mark Finley. He's going to sort of, I think, set the scene, if you will, for where we are today, where we've been, and hopefully that will get us to a point where we can launch into some questions. But before we get to the questions, we're going to hear from Jim, who's going to add a little bit of geopolitical flavor, if you will, to the context of this conversation. And then I look forward to getting into a rigorous conversation and addressing all of your comments. So Mark, the floor is yours.
Great. Thank you very much, Ken. And let me also thank the OTC Live team and to thank each of you for taking time out of your busy schedules, wherever you might be around the world, to join us for what I'm looking forward to. It will be a very robust conversation, I'm sure. I'm going to focus my remarks mainly on the oil market, but a lot of this will have relevance for natural gas as well, and I'm happy to dig deeper into the questions and discussion as well. So right now, today, worldwide oil demand is about 7 million barrels a day, or 7% below where it was pre-COVID. That's a huge decline. And yet, oil prices today are actually higher than they were before the pandemic. Why? Well, I may just be the pointy-headed economist, but my thesis is that supply is falling even more rapidly than demand. Some of that supply decline was driven by market forces. Producers here in the US and elsewhere slashed investment last year when prices collapsed. But the bigger factor is elective production cuts. Motivated by the price collapse, the famous OPEC Plus group, led by Saudi Arabia and Russia, delivered the biggest coordinated production cuts the world has ever seen. And then they actually complied with those cuts. Global oil inventories, which nearly overflowed when demand collapsed in the early days of the pandemic, have actually been falling worldwide since as far back as last summer. So, great. Now what? What's next? What can we expect for the rest of this year and beyond? Those of you who've listened to our podcasts over the last year probably got tired of listening to me saying over and over again, the virus is in the driver's seat. Well, guess what? Good news. It's not anymore. We're now in a two-seater, with Saudi Crown Prince Mohammed bin Salman and Russian leader Vladimir Putin at the wheel, or wheels perhaps. With inventories falling, demand forecasts are now being revised higher, and confident that they will not be challenged for market share by U.S. shale producers, the OPEC Plus group a few weeks ago finally agreed to begin raising output. Let's go through some of the details. On the demand side, the picture is getting better rapidly, although not quite likely to reach pre-COVID levels this year. The International Energy Agency in Paris projects that after falling by 9 million barrels a day last year, which was the biggest decline ever recorded, worldwide oil demand this year is likely to grow by about 6 million barrels a day, which in turn would be the biggest increase ever recorded. And not only that, but it will grow sequentially each of the remaining quarters of this year. By the fourth quarter, the IEA expects global demand to be just 1 million barrels a day below pre-COVID levels. Oh, and by the way, the IEA is on the low side of forecasters. Other analysts are expecting growth this year to exceed 7 million barrels a day. The only real weak spot remaining in the global picture at this point and going forward is jet fuel demand, as air travel remains massively below pre-COVID levels. The key uncertainty on the demand side is how quickly will demand recover? We have risks around renewed virus waves and new variants emerging, and questions about the impact of economic stimulus. There may be some lasting drag with less commuting and more telework, and we can all relate to that. On the other hand, we're likely to see some overcompensation as well, more driving due to reluctance to use mass transit, and Ken's done research on that, as well as the now famous idea of revenge travel as we all break out of our cocoons. Certainly here in the United States, if you haven't already booked your summer vacation, it might be too late because the destinations are rapidly filling up. On the supply side, the OPEC Plus group has announced that it plans to raise output by about 2 million barrels a day, but very gradually over the next 3 months. The single biggest chunk of that will come from Saudi Arabia, which, in addition to getting a higher quota, also will be reversing a voluntary extra 1 million barrel a day of production cuts it made early this year to help support prices. But beyond the OPEC Plus increases, we're not seeing much of a prospect for increased oil production this year. Here in the United States, current production of about 11 million barrels a day of crude oil is still making the United States the world's largest oil producer by far. And moreover, as has been the case in previous price declines, U.S. operators have tried to maintain their competitiveness by dramatically cutting costs and boosting productivity. As prices have recovered, the national rig count has begun to increase, and that has been supplemented on the shale side by a drawdown of the inventory of drilled and uncompleted wells. But all of these positives so far have only served to offset the decline rate of the base of production, which is very high in the U.S., as you know. And the result has been that U.S. production has been kind of flat-ish for several months now. Most analysts expect that at these prices, the rig count should drift higher, and along with that, later this year, we should expect to see a modest production increase. U.S. shale could grow much more rapidly. The Dallas Fed's surveys, for example, show that a lot of U.S. shale operators are in the money at these prices. But even so, most producers and their investors seem determined to avoid temptation, seeking instead to maintain spending discipline and aiming to return cash to investors rather than plowing it back into growth. Elsewhere around the world, we are likely to see some modest gains in offshore production. You all know more about this than I do. A legacy of investments that were already underway pre-COVID, importantly. Here in the United States, which is likely to see small increases both this year and next, depending on the hurricane pattern, but also Norway, Brazil, and Guyana. The big wild card on the supply side, Iran, as the JCPOA negotiations with the United States engage again. Supply has crept up earlier this year from Iran, but a full lifting of sanctions could free up an additional roughly 1.5 million barrels a day of supply pretty quickly. Jim will have a lot more to say about the Middle East issues, including both Saudi calculus and Iran. Now, let me turn back to the overall balance of the market for this year. Remember the starting point. The market was already undersupplied due to those aggressive production cuts. The OPEC Plus group now says that it is targeting a continued reduction of global inventories, and they want to see inventories getting back to their pre-COVID 5-year average. They could easily reach that in the next few months, even with the current modest production increases planned by the group. Then what happens? The big question is, what do our two drivers want? If they want to keep prices rising, they can keep a tight rein on supply and push inventories even lower. But at what point does that become counterproductive? At what point would higher prices push U.S. drillers back into the game? Moreover, we're already seeing consumers growing concerned about higher prices. Indian officials have complained very loudly. And here in the U.S., with prices at the pump up over 60 cents since the beginning of the year, there were rumors that the U.S. had officials quietly raised these concerns with their Saudi counterparts in the run-up to the last OPEC Plus meeting. Now, as always with oil prices, when prices start to rise, analysts race each other to see who can get ahead of the curve. Some are calling for the next oil super cycle and $100 crude. But remember, the OPEC Plus production group is sitting on a lot of surplus capacity. That's the flip side of big production cuts. Even after this summer's planned output increase, the group's production will still be 6 million barrels a day below reference or pre-production levels. That's a lot of spare production capacity. What it means is that with our two new drivers at the wheel, the group can increase production anytime they want. That should help keep a lid on prices going forward if that's what they want. It also serves as a warning and deterrent to people who are considering investing at these prices. Now, don't forget, here in the US, the rocks are still there. Under the right circumstances, domestic shale producers certainly have the potential to raise output significantly. Let me, before I hand it over to Jim, let me briefly look a little bit further ahead. Longer term, we may very well have another new driver or drivers. Massive uncertainty on the long-term demand side. Will the pandemic cause slower economic growth by putting the brakes on globalization? Or will stimulus and revenge travel give us another roaring 20s? How much more, will aggressive climate policy push oil demand? Will it impact, and push us into a decline? Or will carbon capture allow continued oil use even under aggressive climate policy? How will behaviors durably change and preferences with regard to telecommuting and business travel? Over the next few years, however, there should be enough momentum in the, from the COVID recovery and the inertia of our system to sustain continued oil demand growth. After this year, the IEA expects almost 7 million barrels a day of additional growth of oil demand to 2026. Now, about half of that comes next year as we continue our pandemic recovery. Here in the United States alone, the Energy Department expects oil demand after this year to rise by another 2.5 million barrels a day to 2026. So I think the key message is, as much as we want to see successful efforts to deal with climate change, most analysts conclude that we would need to see much more aggressive policy measures to push oil demand into the negative territory within the next 5 years. Let's see what President Biden has to say when he announces his new climate initiatives tomorrow and what comes out of the UN Climate Summit later this year in Scotland. And by the way, when we're talking about implications of these policies for oil demand, it's important to remember this is not just EVs. It's the whole barrel. It's hydrogen for transport and heat. It's recycling for petchems, et cetera. On the supply side, we have all that OPEC spare capacity to work off, plus potentially Iran, plus plans that are already being acted on to grow capacity in Saudi Arabia, the UAE, Russia. All of that potential increase in supply is before we even get to opportunities for US shale and global offshore. One of the key questions will be, how aggressively does that OPEC Plus group try to support prices? Increasingly over time, I think it's likely that they're going to have to turn to a more strategic question. How do you manage your resources in the face of a potential long-term decline of oil demand driven by climate policy? Can they diversify their economies? Will they push to monetize their resources or risk leaving them stuck in the ground? Jim will have more to say about that today and next week, by the way. For producers here in the US and around the world, the question will be, what do you have to do to stay competitive? Can you stay disciplined, work with your supply chains, and host governments to keep costs competitive? And of course, you all know this, but climate policy doesn't only impact the demand outlook. Significant potential for tighter regulation here in the US and around the world, regulating methane, permitting, etc. And this is also likely to impact the supply outlook. There's a lot to digest there. Let me pause and turn it over to Jim, and I'll look forward to the conversation. Thanks. Ken, Jim?
All right. Well, thanks a lot, Mark. Lots of numbers and lots to digest there, as you said. Really interesting stuff. So I'm going to shift gears a little bit and kind of delve into the backstory a bit here, some of the geopolitical machinations within the oil market. And I kind of want to start around the same place, around the start of the pandemic, and just the sort of the disastrous beginning to the pandemic that we saw in oil markets. Despite that that really bad start, and the OPEC's pretty really astounding missteps. They've really picked up their game and played the situation really well. As Mark mentioned, a really extraordinary level of compliance with their cuts. And after that market insanity of April 2020, when we saw that that flash crash in prices where they actually went negative, we've seen compliance hovering between 75% and 120%. So over compliance with their cuts. They're doing more than they promised, and are actually, the scofflaws among producing countries are actually being punished. You've got especially the new Saudi oil minister, Prince Abdulaziz, demanding compensatory cuts in the following months, right? So, how did OPEC Plus manage to crack the whip and get these 20 countries or 19 countries in line? It wasn't just Saudi Arabia. I'm going to argue here that the success of OPEC Plus in the middle of this pandemic is really a product of this improved and improving Saudi-Russia relationship. I think Riyadh and Moscow learned from that April oil price collapse. They're now cooperating really closely, despite ongoing disagreements over strategy. I think the benefits have been pretty clear in oil prices, as Mark spoke about. And then, the Saudis are making some pretty, some decent concessions to keep Russia on board, right? So, the first one of those is that the Saudis are often over complying with cuts. Some of that's due to their own views of the market. Some of that's due to, just their willingness to, retain that OPEC leadership and shoulder more than their burden. But they're also allowing Russia to bring back production online, bring Russian production online earlier than everybody else, right? So, I think Russian producers have made it clear that they can't just twist valves and swing output like the Saudis can, and they've been arguing if they're not allowed to ramp up earlier, they could lose market share to some NOCs that can move quickly. But Russia's also been making some concessions, including, actually just being there, being part of OPEC when it's not really an official member. And Moscow's been more accepting of this Saudi preference for higher oil prices. I mean, I think that was, the kind of the kernel of their disagreement, and has been. And Russia's got reasons for that. They've got a lower fiscal break even, somewhere around $50. That's basically around what they target in terms of price, somewhere around the 50s. They're comfortable. They've got an advantage, sort of a currency advantage, a free floating ruble that's been sliding against the dollar. And so the ruble's devaluation has been raising export rents in ruble terms, even with prices even when they hold steady. And their production costs are in rubles, so they benefit in multiple ways. And Russia targets a lower price also because they really want to dissuade U.S. shale from taking market share. I think Igor Sechin of Rosneft has been pretty adamant about that. He's been personally sanctioned by the U.S. and he's been pretty angered as the U.S. Shale producers were taking market share while Russia and Saudi were holding these cuts, in the past. But Russia also gets some intangible benefits from doing this, from cooperating, in the form of increased influence around the Middle East, including amongst some countries that are pretty strong U.S. partner countries, especially Saudi Arabia. So we know, Vladimir Putin likes to insert himself in between the U.S. And its allies, and he's doing a fantastic job of that here. So I would expect geopolitical reasons for geopolitical drivers to keep Russia cooperating with Saudi Arabia and OPEC. Let's look at Iran briefly. It's like a don't look now, but Iran is coming back, kind of creeping back slowly. Their exports of crude, according to some estimates, are up. So they were up to somewhere just short of 1 million barrels a day last month, right? Last month in March. So that's roughly about half of pre-sanctions levels. And these are estimates from tanker tracking firms, are not official numbers. Some of this is probably coming out of storage, including floating storage. So ships just sitting in the Gulf or in the Arabian Sea. And some of this is being mislabeled, right? It's going out as Iraqi crude or Omani or UAE crude. But regardless, it still constitutes pretty blatant sanctions busting. Biden has not lifted Trump's sanctions, right? So now most of that oil going to China, mainly to these independent, these teapot refiners that can who seem to be able to ignore the sanctions. As Mark mentioned, India has been pretty upset about the price hawkishness within OPEC and Saudi Arabia, and there's been some noises about India and Indian refiners wanting to get some Iranian crude as well. Interestingly, Iran's ramp up actually started in late 2020, so when Trump was still in office, but was otherwise occupied, and during the kind of transition period. When he was not paying attention. Biden administration, since taking office, has been looking the other way purposefully. Hard to know. I mean, these could be confidence building measures. If Iran, they've been pretty cooperative, willing to talk about, getting the U.S. back into the nuclear agreement. We could see this, this creeping up of Iranian exports unofficially continue. A lot of uncertainty around that. I'd say it's pretty tenuous. I mean, the Biden administration could, at any time, reinvigorate or, start enforcing these sanctions, especially if talks stall, right? I mean, I think it's a nice confidence building measure if things are progressing, but a good way to put pressure on Iran if things start stalling. Doing that, sort of reinvigorating those sanctions would create some stresses, not just with Iran, but also with China, which appears to, more willing than usual to kind of test the U.S. these days and test Biden's, get tough on China policy. Okay, so looking a little bit further out and elsewhere, I mean, Mark spoke really eloquently about how, what some of the questions are about the next few years in OPEC markets. I think some big questions about how OPEC and especially how Saudi Arabia is going to play, and how they're going to react. I think, depending on which way the oil markets go, is going to dictate a lot of that. But let's just say, what if forecasters are right and we start to see supply being caught off guard by the stronger than expected return in demand, right? The sort of return of the super cycle. Well, as Mark did mention this, right? We still have this big overhang in OPEC spare capacity for now, but there's still some factors that are limiting supply and future supply as well, right? So we got this decline in upstream investment. We've also got some changes in business models in some of the IOCs, right? Especially the European IOCs, starting to consciously, deliberately move away from oil and the upstream and get into other lines of business. We've got political instability and some above ground issues always in some of the producing countries. That could go either way, and including getting worse, right? So what might Saudi Arabia, the low cost global supplier, do? Well, two broad options, right? One, they could slow walk their upstream investment and kind of cash in on the higher prices, or two, they can increase their upstream investment and increase output and grab some market share, right? So two kind of broad options. First option, the slow walking it would be attractive in the near term. Get this big rent windfall, but that could do what the Russians fear and accelerate the shale development, and maybe even accelerate energy transition activity, right? Like technology switching, et cetera. So probably, to me, it seems like looking at this, the second response is more likely, and it's something that the Saudis have been signaling for a while, right? I think the Saudi production increase, they've been investing in their capacity. That could steady oil prices. It could actually be a positive thing for future oil demand, sort of undercutting the competitiveness of future technology that emerges and disincentivizing switching. And they could grab some market share too, right? So, this is something that the Saudis have been girding for a long time. I wrote about this about 5 years ago, saying that they've been making a lot of noises about wanting to get a larger market share, get that oil out of the ground sooner rather than later and convert it into above ground assets. And last year, Saudi Aramco CEO Amin Nasser did say that the company was officially now raising production capacity to 13 million barrels a day. That's more than they've ever had in the past. And lastly, here, let's talk a little bit about climate change. Right? You knew somebody had to bring it up. Climate action is, I think, you're starting to see it exacerbating some differences among oil producers. Right? So they're always a pretty diverse bunch, but I think that diversity is starting to actually to grow. I think climate's creating this new arena for competition around carbon content, and this, as companies and countries try and cope, what sets these companies apart is their ability to invest or not, right? So to spend money to adjust. So you see these big and technologically advanced producers like Saudi Arabia and the UAE, or IOCs, some of the big majors, and some others. They're already moving along the value chain, investing in these non-combustion uses for oil, especially petchems. Locking in market share in high growth developing countries through buying up refineries, right, and refining capacity in those countries. They're reducing their upstream emissions and touting that, and in some cases offsetting emissions. And then some of these companies, especially the IOCs, moving to gas or electric power, or now, like ExxonMobil, carbon removal. So at least some discussing that. So when oil demand starts to plateau and finally begins to drift down, those companies and countries are going to be in a strong position. Smaller, poorer countries can't really do this. And it's maybe some of the small U.S. producers you might see in that category. So those are the players that might be winding up their operations first, perhaps even with a little push from sanctions or buyouts from other companies. So this is something I'm watching, and I think it's something worth watching as this slow process starts to unfold. So with that, I'll hand it back over to Ken and look forward to your questions.
Excellent discussion, and we do have some questions coming through. Just to create a brief synopsis or summary of what both of you guys just ran through, which is fascinating as usual. The one thing that I think is certainly true is that there's a relatively robust view of short-term demand recovery. And I think it's important to kind of root or ground that viewpoint. And it really is rooted in energy using capital stocks. In the year 2020, we didn't turn over global capital stocks. Everything that was in place in 2019 that drove us to the point where we were is still there. And so in many ways, when we start to reactivate economic systems around the world, we'll be reactivating those same capital stocks, and energy demand should follow suit. I think the uncertainties with regard to travel, I like to quote revenge travel, Mark. I hadn't actually heard that one before, so that's interesting, but I think very apropos. But those uncertainties still certainly exist, and understanding how policy, as we get into conversations about build back better or think about more resilient recoveries, all these sorts of things, how that will actually shape the future as we sort of move beyond 2022, 2023 into 2024, and even out, looking at a decade, right, where there's some pretty serious aspirations. I think President Biden's going to make an announcement, for example, about cutting carbon emissions in the U.S. by 50% by 2030. And you also see a lot of companies making net zero aspirations. Of course, these are longer time horizons, but they're all there. And so that, of course, raises a lot of natural questions about demand, which, quite frankly, plays directly into investment opportunities and understanding, what decline rates might be and how much investment is actually needed given certain scenarios that might play out. I've seen, as we all have, several different demand outlooks that really portray, even in the most aggressive types of 2 degree or 1.5 degree scenarios, you end up with a significant need on the orders of trillions of dollars in investment in oil directed activities. And I think that raises some interesting questions about where will that be. Jim, Mark, you both touched on the Middle East, low cost production, some of the efforts that are being undertaken, in particular in Saudi Arabia. But there's a host of other producers in the MENA region more generally, right, that this will have direct implications for as we go forward. And you can envision a circumstance. I think you both referenced, regulations domestically in the U.S. for onshore production that could be encumbering for future development, in particular methane regulations or permitting restrictions, things like this. That could actually push a lot of development, not only abroad, but also offshore, which actually raises some interesting, things to think about when we think about the future of the offshore industry or the future of the oil industry in general. The other thing that both of you actually sort of highlighted, which I thought was interesting, and Mark, I think you put it really well when you commented on we have 2 drivers now instead of 1, is that in many ways, when we think about uncertainties that we're presented with in global oil markets, in many ways, we're kind of back to normal, right? We're actually thinking about, what are the geopolitical perturbations that could drive changes in the near term and ultimately result in price volatility. It's hard to envision a COVID round 2. Hopefully that doesn't come to pass. I'm looking forward to seeing everybody in person very soon. But that, without a doubt, was the type of disruption to demand that nobody could have foreseen. And then when it actually happened, everybody was just struggling to grapple with, right? I mean, it's unprecedented in many respects. But kind of going back to the future, if you will, going back to what we used to experience in terms of what drives uncertainty in oil markets might be refreshing in many respects. It certainly will be a lot easier to plan through. So when you think about strategic investments and whatnot. So there are several questions. I want to get to a few of these directly that I think will play a really important role in the future of the oil industry. I know you both have done some thinking about. One question is related to the pace and scale of energy transitions and what the potential impact could be on oil and gas demand. In particular, this viewer is actually wondering if we might be underestimating how rapidly things can change, and if we are, what would be the implication in markets?
Well, I mean, I could take a quick crack at it and hand it off, but I've heard the term radical uncertainty being thrown about when you look at the energy transition and how it affects oil and gas demand, because predicting what governments do is really hard. You got a lot of governments, and you've got three really big ones that are the source of most of the emissions, right? So China number 1, U.S. number 2, and India number 3. That's where most of the emissions are coming from. But beyond that, there's 190 some odd other governments that all have a vote here. Really hard to predict what they're going to do and what they're going to do in the future, and things they decide may get unwound by either by non-cooperation from companies or from their own people, or by a new administration that takes office, right? So it's easily to see how really difficult it is to predict how policy is going to change and how it might be enforced. But also, oil. I always envision oil as transportation, right? And transportation services are really valuable. I mean, people will pay a lot of money to go places. If you look at gasoline prices, I used to live in the UK before moving back to the States, and gasoline was about $10 a gallon over there. People were still buying SUVs. They're buying a lot of EVs and a lot of hybrids too, but people are still buying SUVs and fairly large vehicles over there. And there was lots of driving. I mean, the roads were definitely not empty, right? So if people are willing to pay 4 times the price for gasoline that we're paying here, it tells you how valuable transportation is as a service. And there's not really a viable substitute for oil in that market. We're starting to see the emergence of some, but none of them can. And the only substitutes we're starting to see really are mainly in the personal vehicle market, right? And that there's lots more to the barrel of oil than just people in their personal cars. So I think oil is going to be tough. And even talking to folks at the IEA about this, they argue that we might, it's easier to substitute for coal is the easiest, right? You got coal's the dirtiest, the most carbon intensive. It's not actually the cheapest for power generation, not the cheapest source. Every single substitute for coal is cleaner. So I think it's probably easier to push out coal. Gas might be easier in the medium term, because gas also has some substitutes that are cleaner. But oil is more of a transportation fuel, so I see it be a little bit more difficult. I don't know. What do you think, Mark?
Well, I agree with all of that, Jim, and I think I think the way I think about it in terms of two key points. One is to emphasize that uncertainty. Even in scenarios that successfully deal with the challenge of climate, the range of outcomes in terms of what it means for oil demand are huge, and so and that's assuming a massive uncertainty away by assuming that we actually successfully deal with the challenge of climate. So the range of outcomes. I remember it's the once removed International Energy Agency scenarios had literally 100% range for oil demand in 2040, between their aggressive case and their business as usual case. How do you plan on that basis? So always keep that uncertainty in mind. The other key point to me is something that Ken led his remarks with here, which was capital stock. It turns over slowly. And there's things policy can do to accelerate it. But, for example, the average new car sold today can plan to be on the road for 15 years, and maybe, 5% of the world's vehicle sales last year were electric vehicles. Maybe a bit more, but certainly not 10%. And so, change comes slowly without some dramatic force to accelerate that capital stock turnover. And those are, people on this call know these are long-lived assets with big upfront costs, and then they have long economic lives.
Thanks, Mark. Thanks, Jim. Building on that. There's a couple of threads actually that were introduced. We just talked about alternative technologies, transportation, sort of thinking about electric vehicles and how they might actually penetrate and ultimately reduce demand for oil. All that remains to be seen, of course. And I will just point out that, and I've used this example actually before, but back in, I think it was 2018, there was a lot made of electric vehicle sales topping 1 million units in China, to the point where there were many actual headlines that only quoted that number. But what's interesting is when you dig into the actually what happened in China is there were, I think, 24.6 million vehicles in total sold in the country in that year, which means that if there was 1.2 million that were EVs, that means there were 23.4 million vehicles that were sold that were not EVs. And those all have long lives. They all raise consumption. So yes, the share of EV penetration was growing as a matter of the math, quite frankly. But it didn't actually translate into a reduction in the demand for motor fuel. So those are the kinds of things that we kind of have to keep an eye on. And yes, there are efforts in different places around the world that are very directed at eliminating internal combustion engine vehicles, to the point where some governments are making plans to ban the sale of such new vehicles going forward. But there still will be a phase out. And how well those bans stick is another issue. Policy is interesting because it does have the ability to change when costs, if they do rise. So I think those are the kinds of things that we'll just have to keep an eye on. But it's certainly an uncertainty worth internalizing. And the other thing I'll point out on that is in those places where you do see those types of interventions, policy interventions, that's typically not where you're seeing growth, right? So you're seeing a different. You've got to see, for those things to be really impactful in a global setting, you've got to see those kinds of interventions occurring in markets where there's tremendous growth occurring as well. And so far, we haven't seen that. So it will be interesting to sort of see how this plays out. Mark?
Okay, I just wanted to add one more thought on that. I think you touched on a really important issue, which is that it's easy to look at this from the perspective of sitting in our comfortable homes in the United States or in Europe, wealthier countries, and recognizing that the vast majority of the world aspires to the quality of life that we take for granted is an important part of this. The United Nations has 17 sustainable development goals, one of which is climate, one of which deals directly with energy, and it's about affordable energy and expanding the reach of affordable energy around the world. And so, I think that idea of access to energy in emerging economies and poor countries is also something that we cannot afford to forget as we think about this challenge.
Absolutely. I think that's a very appropriate comment. In any discussion about the future of energy in general, not just oil, there's always some reference to the dual challenge, right? Which is addressing the externalities associated with energy, particularly with regard to climate, but also increasing access to modern energy services, which is a big challenge and severely lacking, quite frankly. So, technology is going to play a massive role. Investment is required at scales we've never seen before to do this at a pace that would be deemed acceptable by most. So we are sort of sitting in a really interesting position. Now, along those lines, and to build on some of the themes that you've raised in your previous comments or previous responses. There's a question, actually, there's a couple of questions related to carbon taxes, and wanting to understand sort of how carbon taxes, access to capital, because we're increasingly seeing, ESG investor sentiments being integrated into return metrics, if you will, that will help define access to capital. That in combination with a carbon tax, which would be something that would come from, a government entity, obviously. And we've seen attempts at carbon pricing, but nothing really that is broad and internationally motivated. So when we get into carbon taxes and open the door into border carbon adjustments and all sorts of other things, you're starting to step into a space where you could see some real concerted shifts in investment behavior. And I think we already have seen that to some extent. But the question is really around how will those things really play out? How will they matriculate into the oil and gas space in particular, and what may come, right? And I know this is a big question, and it's a lot to pontificate, but for example, might you see more consolidation because those with scale can actually leverage scale economies and actually absorb some of those costs, or might you see something different? So I'd love to hear your thoughts on that. Mark, if you want to go first.
Well, as the pointy-headed economist nerd, you won't be surprised to learn that I'm a big fan of pricing the externality of carbon. And part of the reason why is because we see how a price signal can generate unexpected solutions. Ken, you and I met when we were both on a study advising the Secretary of Energy here in the United States nearly 20 years ago about natural gas markets. And the concerted consensus of industry, government, academics was, boy, you're gonna have to build a lot of import terminals. And there was that one technology guy in the back of the room saying, "Shale, gonna be big." And it just wasn't part of the mindset of, like I said, a big business, but also government and academics. And yet here we are today with the United States as a massive exporter of natural gas because of shale. I can assure you, having been in the industry 20 years ago, it wasn't on the radars. And yet when there was a signal, high natural gas prices, it provided the right incentive for entrepreneurs to innovate and experiment, and to come up with something new. And so I have no reason, having watched that dynamic play out over my whole career for 35 plus years now, I have no reason to believe that would not be the case if we were to try to apply the same concept to the challenge of climate change.
Sure. Jim?
Yeah, this is something we're going to talk about actually next week. If I can give a little plug for our webinar here at the Baker Institute, we got 3 panelists coming in to talk about carbon competition in the oil industry, and I think that's what carbon tax would look at. So in the panel, we've got a guy from Saudi Aramco, BP, and Wood Mackenzie to talk about decarbonizing oil, starting upstream, but then moving all the way through, and using offsets, carbon border adjustments, et cetera, and how these policy instruments could push down, the emissions from producing and transporting oil, and then offsetting, probably from burning oil products. But I'm also a fan of this, of a carbon tax, right? Leveling the playing field. Let's put a price on the thing that we're trying to prevent, and we'll see this carbon competition start to heat up, right? So we'll see, if grades of crude are taxed more or less based on the carbon of getting that stuff out of the ground and getting it to market and refining it, you'll have companies and countries, starting to compete. So right now, Saudi Arabia would be able to sell, at a $50 carbon price, would get about a $10 a barrel discount on a barrel of extra heavy oil from Venezuela, right? Because of all the carbon that's emitted, or from the oil sands of Canada, from all the carbon that's emitted in all the processing and that's before that barrel is burned, right? So that's so all oil has about the same amount of emissions on combustion, but there's big differences, in their upstream emissions and processing emissions. So you have that. Then you'd also have renewables. The CCS would start to become viable, and you'd have nuclear would be also viable. So I like the idea of I'd rather tax something you want to discourage, like carbon, than tax housing, or a necessity. And with the way here in the U.S. We've got these enormous spending plans, and less of a willingness to change taxation policy. We might need something like this. We might need a revenue source here pretty soon. So there's lots of reasons for it, I think.
Sure. I mean, just to complete the thought on tax, tax is still a three-letter word, right? It's much easier for a politician to put support behind a subsidy, and so that's actually why you see those, prevail in policy discourse and in terms of concerted political action. I mean, there's a lot of stuff on the horizon on that front. We've seen some recent announcements. As a matter of fact, just earlier this week, there was an announcement by ExxonMobil to create a carbon hub in the Houston Ship Channel with the express purpose of being a central point of gathering so that CO2 could effectively be moved to a point where it can be used or injected. That's an interesting proposition, and it's one that they have stated they will need some partnership with government or some government support to execute. But in reality, that actually does open new doors.
Including offshore, right?
Exactly. And that's exactly where I'm going, Jim.
Oh.
It actually de-risks the development to an extent of carbon capture because you now actually have a point of offtake. And so that removes a barrier to entry for a small maybe hydrogen manufacturer or somebody in the industrial gases who's producing CO2 and needs to be sure that there's a place to take the CO2. But it also de-risks the opportunities to use CO2 either in cement production, in various chemical processes, or just for direct injection into saline aquifers offshore. And by the way, we actually even published a study that made this recommendation back in January. When you look at the opportunities offshore, they are tremendous. And there's an opportunity for CO2 injection offshore in the state of Texas, for example, which has a much larger fairway by agreement with the federal government in terms of what is state waters. But there's an interesting alignment, and I think this is important when you think about what role governments might play in potentially incentivizing and even accelerating some solutions. In the state of Texas, if you're in state waters, and there's a tremendous potential for subsurface saline aquifer storage, long-term storage of CO2 there, stuff that's been studied by the UT Bureau of Economic Geology, for example, and back in 2010, 2011, actually, when a study was commissioned in 2009 by the state legislature. But all of that is administrated by the General Land Office and specifically the School Land Board. And what's interesting about that is any lease rates associated with access to the pore space there would generate revenue that feeds directly into the state education fund. So that creates a nice incentive alignment for the development of CO2 sequestration in the offshore. If you look farther afield than just state waters, there is a lot known about the offshore subsurface. And thinking about how that could potentially be tapped into as a point for CO2 sequestration, relatively stable geology that is well understood. That's an interesting area to think about. There are some regulatory issues that stand in the way. For example, there is the Ocean Dumping Act that if you technically right now qualify CO2 as a waste product, would effectively prevent you from injecting CO2 into the subsurface offshore and federal waters. So these are the kinds of things that you can bet will come up in policy discussions, and they will have direct implications for the offshore industry because quite frankly, it's you guys that are lifting oil in the offshore now, but it's also you guys who are going to be putting stuff back subsurface if that opportunity ever avails itself. So it really is an interesting and thought-provoking sort of exercise. So I realize there's quite a few questions that have come through. Some are getting into, some are comments more than questions, but getting into thinking about alternative technologies, what might be actually incentivized. There's a lot of new discussion on the hydrogen front. We've been doing a lot of work on that area. Hydrogen does not necessarily mean we abandon fossil fuels, which is what makes it an interesting potential option for the future. It actually could result in sustaining some elements of the fossil fuel industry, but making them cleaner, in particular, eliminating the carbon externality. There's different ways to think about hydrogen. You've got a massive color rainbow, if you will, that goes from gray to brown to green to blue to turquoise to yellow to pink. And I haven't touched them all yet, right? So what's interesting about that is the technology options that are available are enormous. And that is fairway that has not yet been fully trodden. So it's kind of difficult to say how that's going to play out. But several of those technology options involve the use of hydrocarbons as a feedstock for hydrogen production. Some of them actually result in a carbon to value proposition where you can take the carbon byproduct and use it in advanced material applications, which is a fascinating thing to think about. Because if we can crack that nut and make it commercial, we actually end up in a very different type of conversation about the future of fossil fuels. And effectively, everything that we've referred to today gets turned upside down. So it's a lot of uncertainties. A lot of them are rooted in technology. If you ask me, you can never bet against technology because as a species, we've done a pretty good job of figuring out how to solve the problems that we're confronted with. And we have a big one that we're facing right now, and I think technology is going to play a massive role. Without a doubt, the offshore industry is going to play a role going forward. I know we didn't really get to touch on that too much, but when you think about any outlook for oil and gas demand, even one in which globally demand is declining, there still is a need for a tremendous amount of new oil and gas to move into the market to maintain balance. A lot of that is likely going to be pushed into fairways that are less obstructive. So fairways that aren't necessarily onshore, particularly if those onshore fairways are plagued by other environmental issues. And so that's going to open the door for some tremendous opportunities in the offshore. And that's actually a space that is, quite frankly, one of the largest consumers of technology on the planet. So I think it's a fascinating one also to think about, because the technologies that can be deployed offshore could actually make that a sustainable resource as we move forward. So there's a lot to discuss. I know that a lot of this will be discussed in future OTC webinars. We're also engaging it at the Baker Institute. And I actually hope to see everybody in person at OTC this year. It's been a long year and a half, and I'm ready for it to be over, to say the least. I know my colleagues Jim and Mark are as well. We're right up against it on time. Jim, Mark, do you want to make a final comment to each? Jim, I'll start with you before we close.
I didn't have anything prepared, but thanks for coming. Enjoyed presenting. Hope to see you around the Baker Institute sometime. I mean, all of our stuff is online now, but we hope to be back in person soon, and we love to have you. So, keep the faith, and hope to see you soon.
Mark?
Well, you mentioned, how you have faith in technology. I mean, at the end of the day, that's people, and the people who deliver it, including the people who are in this call. And that's the reason why I think we can have the luxury of being optimistic. Our ability to tackle these challenges is because there's, our single most inexhaustible resource is human creativity and ingenuity.
Indeed.
Excellent. Well, thank you everybody for joining us today, and I look forward to continuing the conversation. And with that, Carrie, I'll pass it back to you.
All right, great. Thank you, Ken. I want to say also a special thank you to all three of you for a fantastic conversation this afternoon. And in closing, we want to invite you and all of our participants to join us on our next OTC Live events May 5th at 10, we have Lessons Learned from the Digital Transformation Journey, sponsored by Technique FMC. On May 19th at 11, The Age of Artificial Intelligence, The Future is Now. And of course, we look forward to seeing everyone again in August for OTC in 2021. Our full schedule for the 2021 conference is available on our website. Thank you for attending and enjoy the rest of your day.